Welcome to session number 3 with Dr. Alan Ellman, the blue-collar investor. In most of these interviews, I simply took the role of the beginner to ensure that the topics were of the most benefit. In this case, I really am. Not kidding. I don't know a thing about options. Alan goes into what options are, how they work, and even 2 of his favorite strategies for generating cash flow in your portfolio using options. This session is a perfect introduction to the concept of options if you've ever wondered how they work or what to do to get started. Or if you just want to watch me look silly while I wrap my head around the concepts. So tune in for a jumpstart accessible to even the newest trader on options. All right. Good morning, Dr. Ellman. Thank you so much for being on here today.
Pleasure to be here, Jacob.
Awesome. So, just to get things started, why don't you give us just a little bit about your background, how you came to trading, and kind of where you're going with your business now?
Okay, well, actually, my career started professionally as a dentist. And I had a practice out in New York. And in the early 90s, I started teaching myself how to self-invest with stock options. And it became very lucrative for me. Eventually, word got out to some of the local investment clubs in my area. They started inviting me to speak at their venues. And the response was just amazing. That ultimately led to my writing 6 books on the topic of self-investing with stock options, publishing over 300 journal articles on the topic, and producing over 250 videos. Ultimately, I had to make a career choice because I could no longer do both. So I opted for educating retail investors as to how to self-invest in stock options, and I sold my dental practice. So I've been doing this now since the early 1990s, but full-time for about 9 years now. And I never looked back. I never regretted it. And I'm just having the time of my life speaking with retail investors and teaching them how to self-invest in the stock market, and specifically with very conservative option selling strategies.
All right. Yeah, and I saw that you, one of the phrases that you like using is that you teach people how to become the CEO of their own money. And I really love that kind of description. It's, get up there, take control, be in control of your own financial future rather than putting it in someone else's hands or letting someone else make those decisions for you.
Absolutely. I mean, I don't think there's anybody else that cares more about our money than we do. So we really have to be very vigilant in terms of how we invest it. And even if we give our money to somebody else to invest for us, we should be able to have the ability to evaluate the type of job they're doing. And that's why education is so important.
Sure. So the thing that I was really curious about and why I really wanted to bring you on here was why options? Why use that as the vehicle?
Well, actually, early on, I started teaching myself just how to invest in the stock market. So I was just buying and selling stock. And I was always kind of math oriented. So I developed formulas based on fundamental analysis, evaluating earnings and sales growth, things of that nature, and technical analysis, analyzing a price chart. And I was doing quite well. But eventually, I came upon stock options. And at the time, I always thought that options were too risky. I mean, that's basically what most people think about stock options. It's way too risky. It's only for the professionals. But I started teaching myself and I realized, there are conservative strategies that involve stock options that can actually elevate our returns higher than just stocks alone. And I started doing my formulas and everything for that. And right off the bat, even way back in the early 1990s when I wasn't as good at it as I am today, I started doing better with stock options than with just stocks alone. So the strategies I use do involve owning stock, but also leveraging those shares with stock options and in a very conservative manner.
Okay, so it's kind of a multi-angle strategy of using both sides. So I guess just to kind of get things started off with this is why don't you give us a quick overview of what are options, why are they different from other vehicles, and just kind of a high level overview to give us the foundation to start with.
Yeah, well, options basically are contracts. They're made up contracts. And one options contract always consists of 100 shares of an underlying stock or an exchange traded fund. An exchange traded fund is a mutual fund that behaves like a stock. So an option can relate to either a stock or an ETF, exchange traded fund. Now, there are two types of options. Call option allows the buyer of that option to purchase 100 shares of stock, and a put option allows the buyer of that option to sell 100 shares of stock. Now, we're going to concentrate today on a strategy known as covered call writing, where we first buy a stock and then sell the option. So, in essence, what we're doing is we're selling some unknown person, because everything's done online with the touch of a computer. So, we're selling some unknown person the right but not the obligation to buy our shares from us that we already own at a price that we determine, by a date that we determine. And in return for undertaking that obligation, we are paid a cash premium that's dictated by the market. So in essence, what we're doing is we are generating a monthly cash flow with the click of a computer, leveraging the stock that we already own.
Okay, that's really interesting. I guess didn't even know that that was an option. So when you're buying the equity, is it that you are actually generating the contract that you're selling, or is it just you happen to be buying a certain number of equity and you happen to be selling a particular contract, and because they're the same underlying equity, they kind of balance each other out?
Well, yeah, the way it works is this. If let's assume for a moment that we want to sell one options contract on stock, Jacob Incorporated. Okay, Jacob Incorporated. You now own a corporation, Jacob. All right, so 100 shares of Jacob's Corporation is purchased first, and let's assume for a moment that your company shares are selling for $48 a share. Now, once you own those shares, you are in what's known as a covered or protected position, and you can then sell the call option. So then you go online, you own 100 shares. Now you go online and you type in your broker account that you're going to sell one contract of, let's assume in this hypothetical, the $50 call option. So in essence, what you're doing is you're agreeing to sell your shares that you own at 48 for $50. And let's make a time frame of 1 month, because that's my sweet spot. I sell basically 1 month options. So at any time over the next 1 month, whoever buys that contract can purchase those shares from you at $50, right? Now, at the end of the month, or let's assume for a moment you get $1.50 on that contract. That's like an average premium. So you get $150 for the 100 shares. Now, on a cost basis of $4,800, that's better than a 3% 1 month return for your initial return. Okay? So at the end of the contract month, which is always the third Friday of the month, at the end of the contract month, there are two possible major outcomes. Let's assume for a moment the price of the stock does not supersede the agreed upon $50 sales price, right? So why would the option owner exercise that option and sell their shares to us at $50 when they could be purchased at market at a lower price? So they're not going to buy our shares for $50 when they could be purchased at $48. So if the price of the stock remains lower than the strike price, the contract will not be exercised. We keep the 3% 1 month return. We still own the shares, and then we could sell another option the following month. Okay, you with me so far on that?
Yep.
Now let's assume for a moment the price of the stock bumps up to 52. Now the option buyer has the right to buy our shares for 50, right? Price of this on market is 52. He exercises the option, buys our shares for 50, and then he could turn around, sell it at market for 52, generating a $2 profit. So if the price of the stock goes above what's known as the strike price or the agreed upon sales price, the option will be exercised. Now here's one caveat, Jacob. We can always prevent that from happening by buying back the option. So that relates to position management after we enter a trade. But that's basically how it works. Now, in that example, if our shares are in fact sold for 50, we have the $150 cash generated from the option sale, plus another $200 on the stock sale, 48 to 50 times 100. That's a $350 profit on a cost basis of $4,800. That's better than a 7% 1 month return. So in cases like that, where you sell an option at a higher price than the current market value, you have an opportunity to really bring home a very, very high 1 month return. Of course, it's not a panacea. There are risks and disadvantages to the strategy, but that's basically how it works.
Okay. So I mean, that makes sense, and really, in most cases, that's going to end up with you coming out ahead and some sort of a cash flow. And kind of like you said, there are of course risks. So what are the I guess risk side of it?
Well, there are a couple of risks to covered call writing. I think anybody that decides on a strategy should understand those, because if we painted any strategy as a panacea, we wouldn't be truthful with whoever's listening to us, right? Because in effect, when we're looking to get higher than a risk-free return, aka treasuries, that sort of thing, then we are getting paid to undertake risk. So there is definitely risk. So let me give you a couple of examples. In that example that we just did with Jacob Corporation, we own the shares at 48. We sold the option for $1.50. Our break even is 46.50. So if the price of the stock declines below 46.50, we start losing money. And we have to know how to mitigate those losses and how to basically control the situation with share price declining. So position management is critical. Uh, and here's the major disadvantage to covered call writing, Jacob. Let's assume for a moment in Jacob Corporation that you're developing different drugs, and the FDA, a week after we write that $50 option, a week later, the FDA approves one of your drugs, and boom, the price of the stock goes to the moon. It's $60 in a week. Now, we as option sellers have agreed to sell those shares for 50. Price is 60. We want to get our hands on those additional 10 points, but we cannot, because we have an obligation to sell at 50. So the main disadvantage to covered call writing is that share appreciation is limited by that strike price that we've agreed to sell the shares for. Now, that said, Jacob, I do have a strategy that I've developed that's in my books and DVD programs where you can actually, in a scenario like that, make more money than the maximum return. But that's on a more sophisticated level than I think we're going to discuss here today. Unless you take me in that direction, I'll be happy to talk about it.
Sure, I'm
But
definitely curious, but
yeah,
um, cool. But and even in that scenario, assuming of course that you bought the shares for less than that strike price, you're still coming out ahead, just not as ahead as you would have liked if the price had gone up so much.
exactly right. And, there's a psychological aspect to it because, I've had the very good fortune of speaking with thousands and thousands of covered call writers, not only from the United States. We have members in 89 countries outside the United States. And a lot of them will say to me, I lost X amount of dollars because the price went above the strike price by so much. When in fact, if they evaluated the mathematics of it, they had a 1 month return of 8%, and they're telling me that they lost money. What they're in essence saying is, if I used a different strategy, I could have made more money. But wait a second, you're not using a different strategy. You're using covered call writing, which has its advantages and its limitations. And as long as you understand those advantages and limitations and you've maxed out your trade, you pat yourself on the back, say, nice job, Alan. You take the cash from the sale of the stock and you move on to your next trade.
Sure. Yeah, the psychology is probably one of the harder parts to get over, because really they didn't lose money. They just missed out on the opportunity to make more money, but they still made something. So that's really interesting. And I've always heard that there were strategies for being able to make money more or less whichever direction the options go, and many people have told me many more opportunities than with just straight equities. But I've never had any idea how that worked. And so that's kind of what you're laying out for me there, is that that's a very, very simple strategy, or relatively simple strategy for most scenarios coming out in your favor.
You could actually craft this strategy, covered call writing. You could craft that strategy to current market conditions. In other words, there are certain options that are beneficial in bullish market environments, and there are certain options that are beneficial in bearish or volatile market conditions. You can also craft it to your own personal risk tolerance. I mean, there are some people that can't sleep at night if their portfolio drops 1% in a week. Well, if they're going to use this strategy, they should take a more conservative approach. Like in my mother's account, I use exchange traded funds instead of individual stocks because, as a whole, those securities are less volatile. You know, they're baskets of stocks. Some are going up, some are going down. So, as a whole, in general, there are exceptions. Those securities are less volatile than individual stocks. So, when I sell an option in my mom's account for covered call writing, my goal for my initial returns are 1 to 2% a month. But in my accounts, I use individual stocks, and my goal for 1 month returns for the initial returns are 2 to 4% a month. So I've tailored the strategy differently for myself than in my mom's account.
Sure. And so I think you kind of start touching on a very important point there of how do we create and pick the right strategy for us? And of course, that's a very individualized thing. But where do we start to kind of outline that and figure out what things might work well for whatever our personal tolerance is?
Well, everything has to start with education. That's number one. And I'm always one of the reasons I'm doing what I'm doing now, and I left dentistry, and I'm very fortunate that I'm at the stage of my life where I can do what I want to do, what I love to do, and this is it. Is that I believe our education system was remiss in not educating us on how to self-invest. It's so important. We work so hard for our money, and then we just don't know what to do with it. So it has to start with education. Now, there are three skills that we must master, and I'm underlining that word master because, Jacob, that's about 3 levels above being pretty good at it. So there are and this is so important because when I was teaching myself these strategies, I didn't have my books, I didn't have my DVDs. I was on the job training, so to speak. And I made every mistake in the book, but I made them only once and I corrected them. So here are the 3 skills to get started with option selling. Skill number 1, stock selection. Now, not every stock is a good candidate for option selling. You have to be able to evaluate which stocks are the best candidates. Now, one exception to the rule would be if you want to use covered call writing, an existing long-term buy and hold portfolio. Some of your listeners probably have long-term portfolios of blue chip stocks that are generating dividends, and they just want to make more money than what that portfolio is generating. And you can use covered call writing for that, but in a very specific way. So, but if you're doing it in a traditional manner, the way I do it in my portfolio, your portfolio is going to turn over pretty frequently. And you have to know which stocks to select. So that's skill number 1. Skill number 2 is what option do you select? So in the example I gave you with Jacobs Corporation, where the stock is 48, you sell the $50 call. That call was higher in price than the current market value. That's known as out of the money. That's a more aggressive position to take. In a bull market with chart technicals looking great, if your risk tolerance permits it, that's the way to go. But let's say the market is bearish. You know, we're worried about the Fed watch. We're worried about issues in China, in Russia, in the Eurozone. We're worried about all those kind of things. We want to take a more conservative approach. Then we might sell the $45 call, agreeing to sell the shares for $45. And as nuts as that sounds, there's a method to my madness because there we're going to generate the same 2 to 4% a month, but we're going to have an insurance policy on top of that that's paid for by the option buyer. Now, that sounds a little complicated, and it is, and I'm sorry for taking us in that direction right now, but I just want your listeners to know that this strategy can be crafted based on the current market environment. And so by selling a strike price lower than current market value, we're going to still generate that beautiful 1 month return, and we're going to get some additional protection on it. What you're not going to get is the opportunity for the price to go higher. So bull market, go higher, bear market, go lower. Second skill, option selection. The third skill, Jacob, position management. What do you do if the price of the stock starts tanking? What do you do if the price of the stock goes to the moon? Jacob Corporation just got FDA approval of a drug. Price of the stock is $60 in a week. What do you do? What do you do if at the end of the month the price is higher than the strike price and you don't want your shares sold? What do you do if there's a dividend distribution and the option buyer may want to get your shares, our shares, and capture that dividend? You don't want that to happen. So you have to be able to adjust to everything that can happen in that 1 month contract. Position management is skill number 3. Once you've educated yourself, Jacob, you're not done. You have to practice a little bit. Paper trade, it's called. And every broker has a platform for that. If not, you could send me an email and I'll give you a free site where you could practice the strategy. And because, I say in my seminars, you're not going to read a book about swimming and then jump in the Pacific Ocean. You're going to have to dip your foot in the shallow end of the pool first. So what you do is you say to yourself, okay, I'm going to dedicate X amount of dollars to my covered call writing portfolio, and then practice with that amount of money in a make-believe hypothetical account. Make all your mistakes practicing. Only take a couple of months. And then once you've educated yourself with those 3 required skills, paper traded, and it's going to take 3 to 4 months for the average investor that knows very little or nothing about this strategy. Now you're good to go for years and decades, generating cash into your brokerage account, whether you need it like I did initially to get my sons through college and professional school. I used it to purchase real estate properties. And now that my sons are off the payroll, I just keep reinvesting. And it's a beautiful thing if you master the strategy.
Sure, and that makes sense. I think one of my biggest question is, what are some of the biggest mistakes that people are making as they're trying to figure this out?
Oh, like I told you earlier, Jacob, I made them all. But I would say there are 2 major mistakes that retail investors make with covered call writing, option selling in general. Mistake number 1 is when they hear about it, they get super excited about it because they see, hey, wait a minute, here's a viable way that I can generate cash into my brokerage account. And it's like instant gratification, Jacob. As soon as you sell that option on your computer, it's like buying a book on Amazon. You click the computer, and like a second later, the cash is in your account. So it's instant gratification. And they get super excited about it, and they want to start selling options. If I do a seminar on Saturday, they're ready to go on Monday. And I tell them, you're not ready. Even if you think I did a pretty good job on this seminar, you're not ready. You got to educate yourself to the highest level. The 3 required skills: stock selection, option selection, position management. Then you've got to paper trade and practice a little bit. And after that 3 to 4 month period, my God, now you've got years and decades to benefit from it without making mistakes with real hard-earned money. So that is the protocol. The education must come first, then practice, then you're good to go.
Okay. And so what's the kind of time horizon that you typically look at here? Is it about a month-long horizon for each position that you're going in and out of?
Yeah, let me backtrack a little bit because
Sure.
I didn't give you the second biggest mistake that retail investors make, because it's an important point. And I know that if I don't say this, a lot of your listeners are going to make this mistake because I was guilty of it, and I'll even tell you a little story about it. There are actually even newsletters that are based around this major error. And here's how it works. A lot of retail investors will select stocks and options based on the return that option is going to give. Now, I told you before that my initial goal in my account is 2 to 4% a month. My mom's account, 1 to 2% a month. Now, the amount of return that we get is based on pretty much the underlying volatility of the stock that we're writing the option on. So the more volatile the stock, the more money we're going to get back. So it's very enticing to sell an option on a stock that's very volatile, like a drug stock or like a stock that's about to report earnings. So here's the mistake I made years ago. I'm not proud of it, but it'll get the point across. When I first started teaching myself about options, and I would see, these options generating 2, 3, 4, 5% a month, I couldn't believe my eyes. I was getting so much return in such a short period of time. One day I came across this stock called Taser, and you may know it as the company that develops these stun guns. And back in the 90s, they were having all of these efficacy programs in various police precincts across the country, testing these tasers. And sometimes the reports would come out favorable, the price of the stock would go way up, and sometimes the reports would be negative, price of the stock would go down. As a result, the implied volatility of that stock was crazy. And the premiums for 1 month options were like 8, 9% a month. When I saw this, my eyeballs fell out of my head. I couldn't believe it. So I went out and bought way, way too much Taser for all the wrong reasons. The main one was greed, because I was generating 8, 9% a month selling these options. So anyway, I continued to generate these very high option returns on Taser as Taser went from 36 down to like $6 a share, and I lost a ton of money on Taser. I learned my lesson. So what you have to do is set your goal based on what your personal risk tolerance is, and your goal should not be getting the highest returns, because that means you are incurring the greatest risk. And for those of your listeners that ultimately decide to use covered call writing or selling cash secured puts as part of their investment portfolio, basically we are conservative investors. This is a strategy where you're not going to be hitting grand slam home runs, but you're going to be hitting singles and doubles all day long, every day of the week. So why take a conservative strategy and convert it into a risky one by selling options on highly volatile stocks? Those are the two major mistakes.
Sure. And as anyone who follows baseball knows, 4 singles is a home run.
You can lead the league in hitting with singles and doubles.
Yep. Yep. Absolutely. And then I don't think I even need to add anything to that. That's a pretty powerful point right there. So if we want to start integrating this into our strategy, is this something that you do as like maybe your main focus, or is this maybe something that you do as kind of a secondary component of your overall portfolio?
Well, I'm a strong believer in asset allocation, so I believe every portfolio should have a stock market presence. I mean, the stock market generates 8 to 10% a month historically. I have a very large real estate presence in my portfolio. There should be some bonds, as boring as they are. They should have a bond presence and cash equivalent. So I'm not saying that stocks or stock options should be the only part of your portfolio. Definitely not. You should have a nice asset allocation there. But within the stock portion of my portfolio, covered call writing and selling cash secured puts, which is a similar strategy, represents about 90% of the stock portion of my overall portfolio. And the reason for that is that's where I've had the most success. Let me just add one more point, because a lot of your listeners, I assume, are retail investors. Covered call writing is the only option strategy that almost across the board a broker will allow in a sheltered or self-directed IRA account. And that's because our government considers this strategy low risk enough to allow us to use it in a self-directed IRA. So since we are generating these short-term capital gains on a monthly basis, some of our members use weekly options as well. It's nice not to have Uncle Sam in as our partner. So if you have the opportunity, if you're going to do covered call writing and you have the opportunity to trade in self-directed or sheltered accounts, you should do so. This is a strategy. If you have, let's say, mutual funds and covered call writing, put your mutual funds in non-sheltered accounts and covered call writing in sheltered accounts. So that's an opportunity. And another thing about options, because there are all kinds of crazy option strategies, some of them involving 5, 6 legs, and you could really go nuts with it. I had a lot of success with what are considered 2 of the most conservative option strategies, and they require, covered call writing in particular, the lowest level of trading approval. So when you say to your broker, hey Charles Schwab or hey TD Ameritrade, I want to start using covered call writing, You have to fill out a form, and they'll ask you a bunch of questions. What's your experience? How much money you're going to put into it? This, that, and the other thing. Of all the option strategies, covered call writing is level one, the lowest level of trading approval, because it's considered very intuitive for retail investors. There are two aspects. We talked about it before, Jacob. One is stock ownership, and most investors know about it. You buy and sell stock. I mean, some may be afraid of it because we were never taught this in school, but most people understand. You buy a stock, you want it to go up so you make money. The second aspect is option selling, which is what people need to learn how to do, and that's basically what I do is I educate people on how to use the combination of owning stock and selling options.
Sure. And so this is also probably a whole different subject, but why use it in a self-directed IRA and not just an individual trading account? What's the, I guess, the benefit
Well,
there?
in an IRA account, the benefit of trading in a sheltered account is you don't have to incur the short-term capital gains tax issues that you would in a non-sheltered account. I mean, if you have a traditional IRA, you pay taxes at the end, when you start pulling it out, and theoretically you're at a lower income level at that time. If you have a Roth IRA, you never pay tax. So there are tax benefits. Listen, I am definitely not a tax expert. So any listener that wants to decide on where to put their money when they're using covered call writing should go to their tax advisor. But from what my low level of tax knowledge is, if you trade in a sheltered account, there are less tax consequences with short-term capital gains, and that's what covered call writing is, short-term capital gains, because we're writing 1-month options. And when you have a long-term buy and hold portfolio, you may own a stock for years and years and years, and if you eventually sell it, it's a long-term situation, so it's at a lower tax rate. It's tax issues, so let your listeners speak to their tax advisors, but I could tell them that there are tax advantages to using covered call writing in sheltered accounts.
Yeah, and I'll definitely reiterate that again for a third time, is if you want to do this and you want to know the information, talk to your tax professional.
Yeah, not me.
Yeah. I just wanted to make sure we touched on that so that everyone made sure they understood why you were saying that was a potential benefit. You also mentioned a second strategy in there that you really like, and that was selling cash secured puts. So what was that?
Yes. The selling cash secured puts is a strategy that's considered very similar to covered call writing because the risk reward profile is the same. If you look at a chart on the risk reward, it would look exactly the same as covered call writing. Here's how it works, and let's go back to Jacob Corporation here, and let's say your shares are trading at $75 a share. Now, when you sell a put option, you're selling some unknown person the right but not the obligation to sell their shares to you. It's the opposite of a call option, at a price that you determine by a date that you determine. In return for undertaking this obligation, you are paid a cash premium that the market dictates. And again, once you click that computer to sell the put, it's in your account in a second. Cash is there. Jacob Corporation is trading at $75. Now, you sell this, let's say the 72.50 put for $2. That means you're agreeing to buy those shares for 72.50 at any time over the next 1 month. And in return for undertaking that obligation, you're getting $200 a contract, $2 a share times 100. Now, if during that contract time the price of the stock stays above 72.50, the option buyer is not going to exercise and sell those shares to us at 72.50 if they could be sold at market at a higher price. So we keep the $200 on a cost basis of 72.50, and that's like almost a 3% 1 month return. The cash is now freed up to secure another put. When I say secure, Jacob, what that means is our broker knows that we are taking on the obligation of possibly buying those shares at 72.50, $7,250 for 100 shares. They get a little nervous. We're retail investors. They're going to say, hey, put that cash into your brokerage account So if that option is exercised, we know you can afford to buy those shares. So that's what makes it a cash secured put. We're securing a possible future trade by putting the cash into our account. Now, the broker will also say to us, we're going to do you a little favor. You have to put in $7,250, but you just got $200 on the sale of the put, so we're going to apply that. All you have to do is come up with $7,050. So that's the amount you put in. Now, a $200 return on $7,050 is very close to a 3% 1 month return. So if the price of the stock remains above 72.50, that's what's going to happen. You're going to have your 2.8, 2.9% 1 month return. The cash is now freed up at the end of the month to then secure another put the following month. Now, let's take the second possibility. Let's say Jacob Corporation dips below 72.50. Let's say it drops to 72. Well, the option buyer can sell their shares to us at a higher price. That will happen unless we take action. So what happens? We buy 100 shares at 72.50. Our cost basis is $70.50 because we got $2 from the put. Now we own the shares at a cost basis of $70.50. So at this point, Jacob, we're no longer an option seller. We are a share owner. What do? Well, there's a couple things we could do. We could sell the stock. The price of the stock is higher than 70.50, we make money. If it's lower than 70.50, we lose money. What else can we do? Well, what we could do is keep the stock for the long-term buy and hold portfolio. Here's a point I want to make for your listeners because they're going to love this. Let's assume for a moment that one of your listeners loves Jacob Corporation trading at 75. But, nobody likes to pay full price. They want to get it at a discount. So they can tell their broker and put in what's called a limit order. If Jacobs Corporation drops to 71, buy 100 shares. And that limit order stays there. If it never hits 71, they never own the stock, right? Or they could sell the 72.50 cash secured put for $2. And if the price of the stock dips below 72.50, they own it at a cost basis of 70.50, which was their target goal to begin with. If it does not drop below 72.50, they just got paid 2.8% not to buy the stock in 1 month. Isn't that a sweeter deal than setting a limit order to buy it at $71 and maybe never getting hit? So if you get hit, you got it at the price you want. If it doesn't hit, you just got paid 2.8% in 1 month not to buy the stock. So you could use selling cash secured puts in lieu of setting a limit order to your broker. And the third thing you could do, if the shares are put to you, you could sell a covered call and use both strategies together. So you have three choices if those shares are in fact put to you because the price dipped below the strike price. But that just kind of gives you an idea how you can integrate both strategies or use one or the other. Now, I'm giving a lot of information to your listeners, Jacob, and it could be very intimidating. I think what your listeners should know is that we're just whetting their appetite. We're just giving them a feel for how the strategy works. And if they think that it's something that they might be interested in, then they could begin the education process. This is not a seminar where they're going to be able to turn around tomorrow and start writing covered calls. But hopefully it's one where they'll have an understanding as to how these strategies work.
Sure. It's kind of opening the door, so to speak, so they can kind of peek through and see if they want to go in.
Exactly.
And that's really interesting. The three kind of strategies that you outlined, it's kind of you can either be active or passive or use it as a kind of supplement to another strategy altogether. In a way, I don't mean necessarily that the strategies themselves are active or passive, but that it's, I guess, could be used in conjunction or on its own, and get to the same results.
Yeah, you could craft the strategy in a lot of different directions, but I have to say that no matter what direction you take it, you still need to be active in terms of position management. Whether you just own the shares, whether you're going to sell them and use the cash to invest in something else, or whether you're going to start covered call writing, because as we talked about before, if you write a covered call on those newly acquired shares, now you immediately go into position management mode, the third required skill.
Okay. And so are you able to resell contracts? If you purchased a contract, are you able to then resell it before it expires, or are you just stuck with it?
No. Uh, Initially, you're selling the contract. So that's called sell to open. So you're initiating an options contract by selling it. You can buy that contract back at any time, and that's part of position management. As a matter of fact, Jacob, you hit the nail on the head. When you're doing position management, no matter which one of the strategies you're using, and I have a lot of them, step one is buying back the option. So if the formula for covered call writing is buy stock plus sell option equals covered call writing, if you buy back the option, buy to close BTC, now that cancels that aspect of the equation. All you at that point are a share owner. You just own the shares. You have no obligation because you bought back the option. Chances are you bought it back at a different price than what you sold it for, but you no longer have an option obligation. You're just a share owner. At that point, you could then sell a different option, wait and see if the price changes, and then sell a different option. You could sell the stock. You have a lot of different opportunities along the way. But absolutely, you could buy back that option at any time. You could resell the same exact option in the same month. I do it a lot. The price dips down, from when I sold it, buy back the option at a lower price, and then if it pops back up again, sell that same option at a higher price. Make one income stream, make a second income stream in the same month with the same cash with the same stock.
Okay, so you could almost think of them like equities in that they move up and down throughout the month, and you'd want to adjust your position both in and out as it goes to, I guess, protect your own risk. I'm
Yeah.
just kind of imagining that.
Well, if you can imagine a stock whipsawing, which is what stocks do, and which actually is what gives value to options. Otherwise, if stocks only flatline, there wouldn't be options. Because with options, there are people betting that it's going to go higher, people betting that it's going to go lower. So as stocks whipsaw, the options whipsaw with those stocks, not specifically in step by step, because there are other factors that play a role. For example, let me just throw one at you. There's something called the Greeks, which are factors that affect option value. One of the Greeks is called theta, which is time value erosion. So if I could draw an analogy for you, if you bought a car, right, and you pull out of the dealer's parking lot, what happens? The price of the car drops in value. What happens the next day? It's worth a little less. The next day, a little less. Same thing with options. When we sell an option, we get a premium for it. Well, the next day there's time value erosion, a little bit less, a little bit less, a little bit less. We're option sellers, so we benefit by this time value erosion. With a casino, we're not the players, and we're generating a premium. And because of time value erosion, if we have to buy back that option, there's a good opportunity for buying it back at a lower price. And so we benefit from time value erosion. Where we could lose is if the price of the stock starts dipping down below the break even. That's what we have to be careful about. But option value definitely changes as stock price whipsaws up and down. You're absolutely right on that.
Okay, cool. So let's kind of go back over and start to kind of sum this all back up, and maybe come up with some kind of action steps for somebody who they've listened to this. They say, all right, this is great. I like this idea. Now what? Sorry, go ahead.
Okay. Again, we're going to start out with the education. That's step number one. And the education, if I could just review it briefly because it's so important, is stock selection, option selection, and position management. As far as stock selection is concerned, there are three prongs to determining what stock to get. One is fundamental analysis, which is sales and earnings growth. Second is technical analysis, which is reading a price chart. And the third are common sense principles, like, for example, avoiding earnings reports or asset allocation, or minimum trading volume. So all three are important in determining what underlying security that you're going to use. Now, the exception to that is if you are doing what's called portfolio overwriting, which is where you already own a long-term buy and hold portfolio, and then you're not selecting stocks, you're just using those shares to generate additional income. So in a case like that, if your portfolio is generating 8% a month and you want to, let's say, add another 6% to that, and you're doing 1 month options, then basically you're going to be writing calls that are going to generate a 0.5% a month. So there's ways of crafting covered call writing to enhancing your long-term buy and hold portfolio. So the second one is option selection. We talked about that before, where we're going to select a strike price higher than current market value if we're bullish and lower than market value if we're bearish. So option selection is critical. And the final prong is position management, where after you enter a trade, what do? Price of the stock goes way down, price goes way up. If the price is higher than the strike price at expiration, or if there's a dividend distribution during the contract. So you have to know how to handle all three things. Education is number one. Once you're in the education, and while you're doing the education, you should be able to paper trade. Get a portfolio platform that will allow you to set up a hypothetical portfolio. Let's say, for example, Jacob, that you're going to allocate $50,000 to covered call writing. You're going to do 5 stocks. One of our rules is you should have at least 5 different stocks in 5 different industries. Or if you use exchange traded funds, you don't have to use as many because you're already diversified with those. But let's say with stocks, if you have a $50,000 portfolio, you're going to allocate approximately $10,000 per position. So if the price of the stock is $30, divided into 10,000, rounded off to the nearest 100, that's how many shares you buy. And you do that for the 5 shares. Then you set up a portfolio. You decide what option you're going to sell. Am I bullish, out of the money? Am I bearish, in the money, lower than? And you set your target goal, minus 2 to 4% a month for my initial returns. You set up your hypothetical portfolio, you sell the options, you're going to come out where you're going to be earning between 2 to 4% a month initially. If you sold out of the money strikes higher than current market value, that can go up. If you sold in the money lower than current market value, it can't go up, but if the price goes down, you have protection. So you could still go down and you could still get that 3% 1 month return. And then you do your position management techniques. Do that for 3 to 4 months, and then you're ready to get started. Start out conservatively. If you think I might allocate somewhere between 50 and 200,000, between 15,000 and 35,000, go at the lower end of the range when you start. And then as you build up confidence and as your skill level increases, then you could start enhancing the amount of cash you're allocating to this strategy.
All right. So there's a nice plan laid out for anyone who's interested.
Yeah.
So just to kind of start wrapping things up, I did want to really quick touch on one of your books in particular, your fourth one, Stock Investing for Students, which is, I guess, now required reading, you said, at the University of Maryland. Why stock investing for students? Why not some other age group or some other subject? Why that one?
Well, Jacob, that was the book that I always wanted to write because I feel very strongly that our school system should be incorporating this material as part of the learning process. I always say, you know, I went to great high school, I went to a great college, I went to a great dental school. I took calculus, advanced calculus, you got to be kidding me, calculus. And when I got out, I didn't know what a stock was. I didn't know how to self-invest. And I felt like we need this in the schools. So when my name got somewhat well known, I decided I was going to spend a year writing this book. Stock investing for students is not about options. It's about general financial principles. It's about dollar cost averaging, dividend reinvesting, mutual funds versus exchange traded funds. It's a long-term plan, almost automated, not quite, but almost automated, how you could start at a young age. In the hypothetical in the book, you're starting at 18, but that could be crafted to anyone's specific situation. It's really good for anybody not near retirement. So if you're 15 years away, 30 years away, I did 40 years away. I took somebody graduating high school at the age of 18 data. I didn't use anything that was crazy. 8% a year. Stock market increases 8 to 10% a year. I used 8%. I used compounding. I talk about mutual funds, low expense ratio mutual funds where you're paying very low administrative fees, like Vanguard or Schwab mutual funds. I tell them when to move on to individual stocks, how to screen for these stocks, and then I show them how to get out of positions. And based on historical data with these proven historical techniques, financial techniques that you learn in school, that finance students learn in school, by starting out with $1,000 at the age of 18, right? Here's the gross annual income I used. Average over the first 20 years of this 40-year plan, $60,000. Average over the second 20 years of this 40-year plan, $80,000. Based on historical data, at the age 58, they have $1.8 million. So it shows them how they could retire relatively comfortably, financially secure. And then, of course, if you have real estate added to that, if you have other investment vehicles, it's even more. But that's the book I always wanted to write. And lo and behold, University of Maryland picked up on it, and they make it required reading now for their honors finance program and their freshman class. And it's in a lot of other schools throughout the country as well. So I'm just very proud of the book, and I appreciate you bringing it up in this interview.
Yeah, absolutely. I mean, I could very honestly say that I wish that I'd been made to read that when I was younger. I I just came to stocks because I worked one summer and did well on tips in the tourism industry, and thought, well, what do I do with this? I guess I've always heard people invest money, so I guess I'll look at that. It wasn't really anything that my family ever talked about. It wasn't anything I ever definitely didn't talk about in school. So I definitely wanted to kind of touch on that one really quick. What do you
Let
think?
me just add one quick thing to that, because there are always going to be people that want to turn their money over to a financial advisor to invest for them. And if you get the right financial advisor, there's nothing wrong with that. But one skill that I believe we should all have as retail investors is the ability to evaluate what that advisor is doing for us. So if we have this knowledge, even if we're not using it ourselves, we should be able to take a look and see we're paying somebody a point and a half, whatever, to invest our hard-earned money. What kind of job are they doing? By understanding the information in that book, or whatever resource they're going to use, they can evaluate what that advisor is doing for them and make a determination as to whether or not they're earning that point and a half. And if they're not, find a different advisor, or just take it on yourself, because as I said before, nobody cares more about our money than we do. Perhaps our kids might care more. Other than that.
So what would you say are maybe some of the best takeaways that you learned through putting together all these different books?
Well, from a personal perspective, I was shocked to learn that I can write a book. I had my doubts because I was always a math science guy, going to school to become a dentist. That was my strength, was math and science. So when I started getting invited to speak at these investment clubs, and I started doing these webinars and seminars, I realized at some point that I had enough information for a book. And I started writing it, and I had my doubts whether I can actually write a book that people would actually read. But when I wrote my first book back in 2006, Cashing In on Covered Calls, and somebody who owned a publishing company on Long Island where I live called me up 3 months later after it was published, and she goes, "Do you know your book is #1 on Amazon on covered call writing?" And I literally almost fell off the chair. And I've held that slot now for 9 years, one book
Wow.
replacing another book. So after a while, I guess I can write a book. But that was one thing I learned. But more important than that was I learned that there is a huge interest among retail investors how to learn how to self-invest. I never thought it was as powerful as it is. I mean, I have been invited to speak throughout the United States in a different city every month now for 3, 4 years. 2016 is totally booked up for me. And, I get these crazy audiences, packed houses all the time, and they're retail investors wanting to learn how to take control of their financial futures. And another thing that I learned is that retail investors, as scared as they are about self investing, once they become educated, the confidence level builds up exponentially. It's amazing to watch them take control of their financial futures when, like a couple of months before, they thought they just couldn't do it because, in essence, that's what our schools taught us. If they weren't going to teach us how to do this, it must be because we're not capable. But that is so far from the truth. So it was a learning experience for me, eye-opening, that so many people like myself wanted to take control of their financial futures. And like I said, Jacob, even if they don't use this information to actively self-invest on their own, they can definitely evaluate what their financial advisor is doing and make a determination as to whether or not they're doing the right thing with their hard-earned money.
Sure. So, just to kind of, I guess, wrap things up here, what would you say were maybe some of the best resources that you utilized along the way, either teaching yourself through the learning process, or I guess maybe even in the book writing process? Maybe somebody's interested in that. But what were some of the biggest resources that helped you out along the way?
Well, I was always a big believer in Investors Business Daily. That's kind of like the Wall Street. It's a financial newspaper. It's also an online, like the Wall Street Journal, but they use a lot of numbers, and I'm a numbers guy myself. A lot of statistics, and they have a lot of very valuable screens in there. And I use a couple of their screens in my own screening process. So that's been very valuable to me. There's also you have to actually be a member of IBD to get that information. Now, there's a free site called finviz.com, Finviz. They have a wonderful free screening process there, and also great for stock news. You go to finviz.com, put in Jacob Corporation. It'll give you all the stories about your corporation that came up recently. So there's a lot of free information on that site as well. As far as reading a technical chart, a very, very good free site that I use all the time is stockcharts.com. You can create your own charts. And if people are interested in how I create a chart, because I have very specific criteria for option selling 1 month options. So I use very specific parameters, technical parameters. They can get that in my books and DVDs and on my website, how I do that. But people are free to use whatever parameters they like. So then, of course, things like CNBC and Bloomberg on TV. So you should kind of stay in touch with what's going on. But you don't have to spend hours and hours and hours a day. Once you've trained strategy, you've developed the 3 skills, it's not going to take that much time. But you need to invest 3 to 4 months on the education side and on the paper trade side before you get going. After that, maybe 3 to 5 hours a month is all you really need to do. And remember now, even though I sold my dental practice and I'm doing this full time now, I spent a long, long time writing covered calls when I was a full-time dentist. So it's very doable even if you have a 9 to 5.
Wonderful. All right. Well, just to, I guess, kind of finish off, if people want to follow up with you or they want to learn more, where's a good place to find you? And, is there anything else that you'd like to mention?
Well, my website, thebluecollarinvestor.com, you have to type in THE first. We have a lot of free information. Let me direct your listeners on the top right side of my website. We have something called the Beginner's Corner. And what I've done is I've produced 2 8-part video tutorials, one on covered call writing and one on selling cash secured puts. Each of the 8 videos is 5 to 10 minutes in length, and you could download the PowerPoints for free. So there's 8 videos for covered call writing, 8 videos for selling cash secured puts. It's a great way. It's kind of like in school, the Cliff Notes, that gave you like the overview of a book if you didn't want to read the book, but it kind of gives you an overview. And so that's a great way to get started. There's also a blog page in there where I write a newsletter. That's also for free. There's a ton of free tools there on the website. And there's also a store which has my books and DVDs for purchase to take things up to an even higher level. I also answer my emails, so if you want to write me at Alan, Alan, at thebluecollarinvestor.com, I'll get back to you. And, best place to go is to the website, and the resources there will take you to the promised land as it relates to these two strategies. That's my expertise: covered call writing, selling cash secured puts.
All right. Well, hey, thank you so much, Alan. I really appreciate you taking the time out of your day to come and talk to everybody, and I hope that everyone is able to get some really good value and maybe interest a few people in taking a look at options.
I enjoyed the conversation. Thanks for the invitation, Jacob.
You're welcome.